Good day, fellow investors. I opened Bloomberg yesterday and this was the news. Suddenly, everyone is talking about interest rates going up, crashing the market, crashing the bonds market. Then I even got an email from Ray Dalio why I'm worried that the US government will go broke and what to do to prevent it. In this video, I want to discuss the debt cycle, interest rates, the debt sustainability, where Dalio says that it will go broke, the US, the market finally waking up to interest rates, and the takeaway for us value investors, how to position ourselves going forward. Let's immediately start with Ray Dalio's position on the US government now going broke, and in short, very good articles he has shared with us, 3 chapters of the next book. We are here. All looks great, or at least it looked great until a week ago, but for now the economy is still good, job data are really good. And then when we read Dalio, in this stage, markets, economies seem great, most everyone believes that they will get better, they are financed by a lot of borrowing, and wealth is created out of nothing. Brookfield stock that we discussed. By wealth being created out of nothing, I mean that there is greater imagined wealth rather than actual existing wealth. When this bubble ends, the bubble pops, the combo of tightening and unsustainable debt growth reverts, self-reinforcing contraction, there can be a reaction of policymakers that solve the situation like they did in 2009 with more debt, but that can work until more debt simply can't be done anymore. And when more debt will not solve the situation anymore, the day when you don't go to work the next day for the same amount of money. When you say, wait, you just printed so much money, inflation, this or that, I'm not going to work tomorrow for the same money, then simply there is a limit to how much a country can print. The debt has to readjust in line with real income, and then we have the downturn on the cycle, etc., etc. So for now, the economies are growing above the productivity line because of the increase in debt. We'll see more about that later. And then we have to get back that overgrowth here with undergrowth here. And let's discuss how economic growth has actually been fueled by debt over the last years. This was a good article that I read from Jesper Rangvid, who is the professor of finance at the Copenhagen Business School. I know a founder there, Hyper. Very interesting article showing how the US growth is debt fueled. Interesting to compare the euro area and the US. So euro area was growing okay in the 2000s, also the US housing bubble, but then the growth really diverged. But if we look from 2007, US debt to GDP here in the blue was 35%. Now it's close to 100%. So that's a huge increase in debt to GDP that has also fueled faster economic growth than Europe, for example. And here there are multipliers of how much does government spending increase economic growth, and you have from when you spend $1, you increase economic growth by 20 cents to $2.5. So it is usually always a positive for economic growth, and therefore more debt leads to higher, faster economic growth. But the key question to ask ourselves there, how sustainable is that? For how long can you just borrow like there is no tomorrow, spend like drunken sailors, like would Druckenmiller say? And to look more into that there, we're going to the Congressional Budget Office plan for the next 10 years. And nobody plans to lower spending just to increase deficits. And from my calculation, it is planned that deficits are 7% of GDP into eternity. Okay, that is because now nobody's making any problems. Debt to GDP went from 30 to 70%, 7% going forward is likely unsustainable, and that is now in the media. Maybe next month it will not be in the media, but now is the focus. And perhaps this is the key factor here. Now the deficits are needed to mostly pay the interest on the previous debt levels. So when you start borrowing to pay interest, you know that things are not sustainable, and therefore debt becomes unsustainable, because when you have to pay interest on interest, that's usually called compounding, and that's what we focus as investors. So until you say enough, the debt cannot be 120, 150, 200% of the economy, until then, maybe there is still some legs, some room to run, but not eternally. That's the key to know. And the market is finally waking up to the news. We look at the global bond tantrum from Bloomberg. Simply, interest rates, the 10-year went from 3.6 to almost 5%, and now people are saying how they would not be surprised if they get and stabilize at 5%, perhaps even more. Now people are increasingly worried of debt from the UK to Japan. US 30-rate mortgages are shy of 7%. That weighs on house purchases, and of course that also leads to contracting housing demand, housing spending, whatever. That later also can lead into a recession. And then historians point out that a raising 10-year note yields have foreshadowed market and economic spasms as the 2008 and the previous decade bursting of the dot-com bubble. Wall Street economists pare back Fed rate cut after views of data, job doing well, so unlikely that the Fed will manage to lower rates, and maybe we will have higher rates for longer, also because politicians have zero appetite for fiscal tightening, and therefore you know that an investment in a bond long term will simply deliver bad returns. Therefore now there is a premium for bonds that hasn't been there for a decade, because bonds were usually giving negative returns. The new normal, perhaps 4%, maybe we'll go to 7%, and that would have a very bad effect on markets, of course. But there are other factors that nobody is discussing because you can't do much about. We have now deglobalization, aging population, political volatility, the need to spend money to climate change, the need to spend money to pay interest, and now with Trump, investors are concerned over debt deficits a little bit more than before, says Ed Yardeni, and yields might go to up to 5%, but that doesn't matter. Yardeni also said a month ago that the S&P 500 will go to 7,000. If yields go to 5%, the S&P 500 will go to 5,000, not 7,000. But okay. The key thing here, the funny thing is that it takes so much time for the market to recognize things and then react. Because we did this video on Druckenmiller on his interview, I think a month, maybe even more, a month and a half ago, and he said, I'm short bonds. I'm short bonds. What happened since he said that? Well, long-term bond went from 3.6 to 4.6 for a 25% up, also the 30-year treasury, so he made a killing on that. But then there is also reflexivity. Less housing, less spending, that could allow maybe in the future the Fed to lower rates, but then also the economy would do worse, less earnings, so that is the place we are now, and living as always in an uncertain situation, because nobody can predict the future. Everything looked great in December, but now it's already January, right? And the top stories go around: Treasury sell-off, US inflation is set to back Fed pause, so higher rates, lower stock prices, everyone, Asian stocks are under pressure, and Wall Street now fears the lose-lose market. Lower rates, lower earnings, lower economies, but still stocks down. The Fed might be forced to pause interest rates cuts as interest rates are rising, and lower interest rates lead to inflation. So the key is that there is huge debt-fueled economies which simply distort real markets. For now, for the last 15 years, we have had a distorted interest rate market because the Fed simply said that is it. Thankfully, technology, globalization, inflation was lower because we were buying all the stuff from globally for cheap, good technology improvement, and now we are maybe back to reality. And when it comes to the investor takeaway, Ray Dalio says that big debt crises are inevitable, sooner or later. When? Impossible to know, because maybe we have another leg, 5, 10, you never know. There will be new shocks that we don't even discuss at the moment. The key thing when it comes to positioning is, okay, if there is another leg up, I'm leaving some upside on the table if you're just directly invested into markets. On the other hand, if you go to bonds or something like that, then you are protected, hedged, but you have a limited upside, but also the limited downside. And that's the standard risk and reward whenever it comes to investing. My take is that we invest over a 50-year long-term cycle, average investing cycle, and then if you build brick by brick, and you find to invest in bricks that do good no matter what, that's then a great investment. And if we look at our value investing quadrant, what would be a brick that will be there in 10 years, no matter what happens with the markets? We still have to eat, I think, so that is something that is relatively cheap now compared to the rest. If there is a crash, Berkshire will invest the 300 billion into better returns, and that's also something that will be around in the next 10 years. It is pretty expensive now, therefore the low reward, but it is a low risk given the cash position. You can also check my research platform where I have 15 interesting investments that will likely be there and also a hedge. So that's the situation. I cannot predict the future. They are trying, but nobody can time it rightly. So we have to be prepared for whatever comes around, and you can be prepared if you find low risk, good reward investments no matter what.